Brad Williams, Frugal Finance, brief video on mergers and acquisitions and how does it impact investors. Statistically, mergers, acquisitions don't work, period. Over a period of time, and you have to look at a 5-year history, about 65% of mergers and acquisitions turn upside down. You're going to see 2 to 3 years into an acquisition where the corporation is going to have this huge write-off because, one, they overpaid, and two, the so-called synergies that they sell the market on never come to fruition. The personality conflicts remain, causing a huge divide. The cost savings didn't pan out. Subsequently, the merge or acquisition is a failure. You can read up and do your own research, but you're going to find the roll-ups, on the other hand, seem to work. That's where, in this era, you see this ongoing private equity rush to try to monopolize on sectors. So there's a case right now in Texas where a private equity group came in and bought up all of the anesthesiologist operations in a regional area. And then they subsequently monopolized and set the price. It was staggering. And this is not alone. The construction industry, believe it or not, the HVAC industry was hot for a while where the private equity was coming in and buying them left and right. I can't see in the long term where that's profitable. You saw for a while, and I don't know if it's still going, where a group in London was buying up all of the music rights for different groups. I don't see in the long run how that's going to prove profitable, but that's sort of the same thing in terms of mergers and acquisitions and buy-ups. Corporate mergers and acquisitions can have a significant impact on the value of stock held by investors. But apart from the potential for sudden price changes for impacted shares, what else do investors need to know about mergers and acquisitions? What are M&As? They're generally lumped together and can have similar motivations. Mergers and acquisitions are different. A merger occurs when companies combine to create a new entity. Shareholders of the original pre-merger companies receive shares in the new firm at a predetermined formula. The shares aren't usually distributed evenly, as one company is normally valued higher than the other. In an acquisition, one firm purchases and absorbs the other, retaining its own corporate structure. Shareholders of the target firm receive shares in the parent, or cash, or other compensation based on the agreed upon takeover price. Why do companies engage in M&A? There are many reasons why executives might pursue an M&A, including increased market share. Acquiring a competitor can provide a company with a path to increase its market share in a relatively straightforward manner. Economies of scale. A company tends to become more streamlined in some areas as it grows. Duplicative jobs, process, and physical assets can often be eliminated or sold, and fixed costs are spread over a larger enterprise. This is a commonly promoted merger benefit. And again, it's overhyped. Synergies. This is the most overused word in investing. Combining operations might lead to increased efficiency. No. For example, each company's salespeople can begin to sell their other firm's product lines, increasing revenues. This is a frequent defense of mergers, particularly for companies in similar spaces or with overlapping customer bases. Diversification. Buying a company in a different business allows the firm to diversify its operations quicker than starting from scratch. This is a case where a perfect example would be GE, and it worked for a while where they were in 16 different businesses for diversification, and it didn't work. Growth. M&A can help grow revenue faster than organic growth, particularly if a company wants to penetrate a new market with higher barriers to entry. Now, this is where a roll-up comes in. How does it work? Again, I use that HVAC, heating, ventilation, AC. Those companies where you have mom and pop operations, it may make sense to try to monopolize in that particular sector. What happens? It's called a roll-up. And a PE, a private equity group, will come in and they'll buy 6 to 8 different HVAC companies in the region. Then they'll control the pricing, and subsequently they'll try to form a monopoly. Is it beneficial? No, but it's one of these techniques that is created from Wall Street that is overused because, one, these private equity groups generally overpay, and that's good for the seller. Locking that seller out from doing business, like type business, in the area for a long period of time. In other words, you sign a contractual requirement forbidding you to do like kind business in the area for, it could be 5 years, 10 years, what have you. Tax benefits, there could be a tax benefit there. Acquiring company sometimes targets a firm with significant tax losses that the buyer could benefit from, potentially for years. Acquiring technology, knowledge, and talent, this could be one of the key benefits. There are often limited sources for obtaining these assets in cutting-edge industries. Companies can use M&A, enter or catch up to leaders in fast-moving sectors like artificial intelligence or niche businesses. How about to monopolize, period? That would be the reason you want to acquire. You want to take out all your competition, period. You want to be number 1 or 2 in your industry. And how do you do that? You take out all the other players. Is it fair? No. Is there a defense against it? Well, kind of. The government's supposed to overlook that. The Federal Trade Commission is supposed to forbid monopolies, but we know how politically that can be skewed. How do companies approach M&A targets? A senior executive at one firm might contact a counterpart at another firm privately to gauge interest in doing a deal. If the second firm is receptive, they could try to negotiate an agreement. They typically keep their discussions private until they reach a preliminary agreement to avoid impacting trading conditions for the shares of either company. Other times, a firm will hire an investment bank to shop itself around for a potential buyer. If and when the news surfaces that a company wants to be purchased, it will likely impact trading. What if the target resists? The target company might publicly or privately rebuff an M&A interest. If the interested party continues its pursuit above these objections, this is known as a hostile takeover attempt. Generally, this would-be acquirer will purchase a large stake of its target shares in the open market before announcing its intentions. While corporate executives have a fiduciary responsibility to try to increase shareholder value, there are reasons that management might refuse an offer above the company's current share price. Well, the duh factor is, I'm the CEO. I kind of like my position here. I kind of like the salary. I kind of like being the leader. I don't want anybody ruffling my feathers, so we're going to play a game here. We're going to pay these people to go away. Greenmail. It's common. It's pathetic. If there is a reasonable price for an acquisition, the CEO should give up his position, her position, and sell the company or merge, period. But, the arrogance and hubris of company CEOs, that's just the way the game is played. Perhaps their growth plans are progressing and they expect to deliver greater value in an independent company that the hostile bid occurs. Or maybe they believe the bid undervalues the company. If the offer is in shares instead of cash, management might question its value given that shareholders would be heavily dependent on the acquiring firm's future performance. In fighting over a hostile takeover, the target firm might seek out an alternative purchaser, known as white knight, to offer what the target firm views as a more attractive financial terms or a more appealing post-merger operating structure, sometimes including retaining existing management. Another strategy to fight off an unwanted takeover is for the directors of the target firm to adopt a poison pill plan. This takes several forms, such as offering additional share purchases at a steep discount to all shareholders except the would-be acquirer, staggering director elections, or requiring a supermajority on votes to approve a merger or remove a director. But the goal is to make it more difficult for the bidder to complete a transaction in a timely manner. Take Meta, for example, Facebook. Zuckerberg has pretty much control of the company. The reason being, there are multiple classes of share. You have the A class, which is for the common shareholder. Then there's the B class, which is pretty much the controlling interest. And Zuckerberg controls pretty much the class B shares and the voting right. Subsequently, if you try to walk in and buy Meta, you're not going to be successful unless you have way too much money and you overpay for the company. What's the impact of M&A on investors? Sudden, unexpected gains can be substantial after a potential deal is publicized. Shareholders can benefit further if a bidding war breaks out between rivals or management holds out for a better offer. An elevated share price can increase your risk, however. Your gains might evaporate if enthusiasm wanes or no transaction materializes, or a poison pill that appears intended to prevent any deal rather than encourage a higher bid could also bring a stock back to earth. When a stock is in play, its share price is heavily dependent upon market psychology, which can shift rapidly. And there's no guarantee merger speculation will lead to a higher price. Potential deal is not well communicated, or there are questions about its funding, the target shares might struggle. Some believe M&A offers, both friendly and hostile, are a great way to release untapped value. Others sometimes argue that this activity often enriches bankers and lawyers at the expense of the shareholders, employees, and even customers. If you find one of your portfolio holdings involved in a merger activity, do your own research and consider consulting an investment professional to determine whether the stock still fits with your investment strategy and risk profiles. Comment. Let me know if you're an expert in this arena. If you agree with me that mergers, acquisitions generally are unsuccessful in the long run, 5 to 6 years, not a year or two. Whether you've had a lot of success, whether you like to play, it's called acquisition arbitrage, where you play the game that another bidder or a higher price will come in, and you buy up 100,000 shares, or you buy a bunch of options, and you play that game. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.